Happy Friday. Brian Manning here with the weekly update. Let's get right to it, man. I am so excited to be back doing these again. Yeah, I mean, maybe the news is a little challenging, but we're going to get through it. But I'm super stoked to be back here. So let's see. So beginning of this week, we have the Federal Reserve, and the Federal Reserve, starting back several weeks ago, had to put into place this version of quantitative easing, which they did back in 2009 as well. Now, the purpose of quantitative easing was to put liquidity in the marketplace when liquidity was not there. So part of their way of doing this is through purchasing mortgage-backed securities. And by keeping cash going into the mortgage-backed security market, it keeps lenders like us in business and gives us the availability to continue doing mortgages for borrowers as well. So on a daily basis this week, the Federal Reserve was buying anywhere from $5.5 to about $6.2 billion of mortgage-backed securities. Now, these are only conventional loans. This is a standard conventional loan, a regular Fannie Mae, Freddie Mac loan. This is not FHA, not VA, not high balance conforming, not jumbo, just standard conventional loans. But they've been able to do this and really hold rates steady. What's crazy though is several weeks ago when they came into this with just swinging like they were going into a crazy fight. At that point in time, they were buying 165 to 180 billion dollars a day, which just totally rocked the markets and just added more instability than was worth into it. So now they're 5.5 to 6.2. They're averaging about $132 billion a month in mortgage-backed securities. So really good to see the Federal Reserve kind of find their footing and what they're doing with this version of quantitative easing, hold it very steady, and that's really helped mortgage rates stay very steady right now. And really rates are at historic lows. So good to see. Unbelievable, but another month has gone by. It's already jobs week. Wednesday of this week, we get ADP. So ADP is the largest provider of private payrolls in the U.S. And when they look back at the month of April, ADP says that there was 20.2 million jobs lost in the month of April. To be exact, ADP said, and it's crazy that we go by 0.2 because normally if you look at a jobs report, 200,000 jobs is a huge number to have in a jobs report. And now the jobs numbers are so big that we have to go at it with decimal points. But to be exact, they had 20,236,000 job losses in the month of April, which is just unbelievable. Also shows that unemployment report right now is running at around 18.7%, which is crazy. Thursday this week, we got initial jobless claims. So every single Thursday, we look at how many people filed for new unemployment, right? So initial jobless claims. So expectation was 3 million people last week filed for unemployment, and it was 3.169 million new people. So that's anyone that hadn't filed for unemployment before or was not continually filing for new claims. 3.169 million people filing for unemployment, just really huge numbers. And then today, the first Friday of every month, we get the BLS. So the BLS is the Bureau of Labor Statistics. This is the government's version of what do they see what's happening with unemployment. So BLS came out and they said, hey, in the month of April, we say that there's 20.5 million jobs that were lost. Now, I don't fully believe this, and I'll tell you why. The first thing they do is they pull a sample week. So they only look at what happened with unemployment during the week of April 12th through April 18th, right? So there's a large gap of April that's not even accounted for. The second thing was that the government basically threw out their modeling. They used to use this birth-death ratio, right? So what they would do is look at how many companies in certain sectors were started and how many companies died or were just put out of business. And when you look at companies that were started and what their average for job new hires would be, companies that died and what their average for loss of jobs would be, and their modeling, they would figure out what the unemployment was. Well, they threw it out the window. I really have no idea what they're doing right now to figure out what their job modeling is, or if there is any modeling. It's just kind of like saying, hey, we think the number is this. So certainly looking at a sample of 1 week in the month of April, I actually think that the unemployment number is higher than what they're telling us. Because if you do away with that and you also look at what's called the household survey is when about 60,000 households get called and they're interviewed about their employment status. And through the equations that are looked at in the household survey says that there's about 22.5 million job losses in the month of April. So there certainly is some incongruent information floating around out there. Something we talked about a week ago, and I just read an article about it as well, is going to be potentially the future impact of, hey, when the economy does start to open up, what is this going to look like in the service industry, and are we going to run into trouble? So, for example, certain areas, restaurants are running into issues because unemployment now, which was extended, pays an extra $600 a week and goes through July 31st. Many people can actually retain on unemployment, not go to work, and earn more money on unemployment than they could if they go to work in specific service industries. So something we're going to have to watch out for here in the future is what's called wage pressure inflation, meaning if you want to get your restaurant or your business back up and running, and you reach out to your employees and you say, hey, we're ready to open the doors, and your employees say, that's great, I'm not going to come back to work right now because I can earn more on unemployment, and you say, hey, I'm going to pay you more to come back and start working. Well, now you've raised their wages, which adds to inflation. That's called wage pressure inflation, which would have an impact on interest rates as well. So it's going to be interesting to see what happens in the future with businesses opening back up, employers going out to their employees and trying to get them and lure them back into work, and they potentially are making more on unemployment than they would if they worked. The last thing I would say, which makes no sense to me, it's crazy, is that stocks are just off to the races. It's really crazy to see such drastic unemployment numbers, which would normally just crush a market, and stocks are just like ignoring what's going on there, and I can't figure out why. And just the Dow of 300 points, it's just, I don't see any congruency there as well. It's really a strange time that we're living in. On a side note, super excited that realtors are back working again. You guys are out showing properties. I know it's on a county by county basis in the state of Colorado, but I'm around. I'm available all weekend. So if you're out showing homes, you have any questions, you need a pre-approval done, give me a call. I would love to help you any way I can. Happy Friday. Hope you have a great day.